You were not ready, Josh. You were not ready for the music to slow down. You thought it was gonna just ramp up right there at the end. Hey guys, welcome back. It is Wednesday, live at 5. Josh Lewis of Buywise Mortgage, myself, here to discuss real estate market update, talk about housing, talk about loans, mortgages, answer any questions you have about the housing market. So put your comments in, or your questions rather, in the comment section below. We'll address them as we can, as we do. Josh, welcome to the show, my friend. Josh just had a cold the last 24 hours. So we're gonna see how he's feeling.
We'll see what this shakes out and turns out to be. My test was negative. My COVID test was negative. It suggested I come back again. So we'll see. We'll see how it shakes out. Thankfully, you can't transmit COVID through the YouTube, so we're safe. Or a cold.
I don't know.
Either way.
The CDC might come out and make you wear a mask when doing
Should I mask up for everyone's safety?
Or perhaps it would keep us all safe.
That's a good idea.
Too good. So we've had a couple updates this week on nothing really housing related, so to speak, but we've got some CPI figures. We got some updates on interest rates, or Josh will update us on interest rates throughout the show. I'm sure that question will come up quite often. We also got some updated guidelines from Fannie Mae. We'll talk about that a little bit with regards to being able to use past rental payments in order to maybe help you add credibility with regards to your credit score. If you don't have enough credit to actually qualify, they're going to change that. But Josh also has a take on what he feels like would actually be a better idea on that. And Josh, we can actually roll into that right now. So Fannie Mae this today, actually, right, came out and said that they were going to update their guidelines to allow homeowners or people looking to buy property, allow them to use their monthly rental payments, if you will. Just kind of like, if you're making a mortgage payment, those show up on your credit report. You can see the history. You can see if they were paid on time, if they were late, so on and so forth. So they're going to use that to allow borrowers to have more credit. Is that how I understand it?
It should be augmenting. So like FICO or Experian right now will allow you to add other utility bills, cell phone, gym, that type of stuff. You submit your bills and they will add that to your score, and it gives it a little boost, but it's only one bureau. So I'm sure they would be doing something similar. You would need to get a rating from your landlord, submit it, and it could give you a boost. Probably the bigger, more important thing that's been talked about on the credit side that would help a ton of people. FICO has a monopoly as far as Fannie, Freddie, FHA, VA, USDA go. There are other credit scores out there. None of them are allowed to be used with any of those loans. It's an absurd monopoly. The algorithm has not really been updated since 1994. There are, I believe the number, I mean, it's right in this range. There's a number of like 40 million Americans would have credit scores under Vantage Score that they don't have under FICO. Vantage Score is more accurate. It's a better algorithm. It gets more people, more scores. And with all of the noise in Washington about housing inequality and helping more people, it's probably the number one thing we could do, getting more accurate credit scores and a broader base of credit scores for people who are left out now. And that's people who don't have a lot of credit in terms of the traditional banking system, but they do have cell phones. They do have bank accounts. They have other things that can be taken into account. So it'll be interesting. There's definitely, for the first time in a long time, have we seen any traction of any alternative credit scoring model besides FICO being used. It's important. A credit scoring model is important. We need to be able to gauge the credit worthiness of a borrower and their likelihood to repay. Unfortunately, there are systemic biases in the FICO system that either they need to work on and get out and come up with a new and improved version, or we need to look at options like Vantage that are better and broader in terms of their inclusivity.
Got it. So yeah, not implemented quite yet. I think the initial thing that we discussed about rental payments, I think that's September 18th. It'll start being implemented, and then it'll probably take a little bit for that to actually go into effect. So if you're somebody out there maybe not having enough credit to qualify for a loan for one reason or another, stay tuned, because that might help you. But let's dive into some questions here, Josh. Get this thing started. Alan Said. Bought a single level home. I pay a separate ground lease for the land. I have the option to purchase the land in 2029, converting the land ownership to fee simple. What are the benefits? So when you buy a property, there are two types of land or two types of property you can purchase. One is a land lease and the other is fee simple. And it's kind of backwards in a sense that if you read it, you think, land lease means that, you lease the land, yes, and fee simple means that you might pay a fee to the land as well. So it's a little bit confusing, but the fact is fee simple means you own the land. Land lease is you're leasing the land. And here in Southern California, actually in Huntington Beach, we have a couple of different condo complexes that actually are on leased land. And for the longest time, we had a huge community of single family homes that was also built on leased land. And these homeowners had the opportunity over time to pay out that land lease, a lot like what you're talking about here. Or at some point in the future, it would automatically convert to fee simple at the end of that lease and so on and so forth. So it's the benefit of having fee simple versus a land lease is, if you're going to sell that property, typically speaking, owning it outright, owning the land is going to be of more interest to buyers than something where there's a land lease fee. And a lot of times with land lease fees, they can go up, right? A lot of times they're tied to the CPI, and they get adjusted on an annual basis. So land leases can actually go up over time. So if you have an opportunity to buy it out now, it might actually save you money versus waiting to some future date. So, you may look at that. In some cases, the land lease is so low that it doesn't really make sense to pay it off. And I've seen that as well. And I've also seen, like here in Huntington Beach, for example, the ones that didn't pay off that land lease, and then decided to sell their property while that land lease was still on there, they had to pay a transfer fee of 1% to the new homeowner. And, we're talking of the balance due. And for example, of the purchase price, sorry. And so the one I sold about a year ago was actually it's been about 2 years now. It was about $800 and something thousand sale price. They had to pay $8,000 in order to transfer that land lease to the next buyer. So, depending on how it's worded, it may benefit you to pay it off sooner rather than later. So there's not really a clear-cut answer there, but I would say it's definitely more appealing to a buyer if there's not a land lease involved at all, and can likely probably get you a higher price because of that. So sorry, a long-winded answer of getting there, but hopefully that was helpful. Let's see here. So one of the questions we're going to get a lot tonight, Josh, and this is it, is buying versus waiting. When's the right time? It's something we see often. It's something we address often. But Parky is asking, in the process of buying a first home, hopes that they're making the right decision, been told many times that it's not a good time to buy. Why? Help. So I always answer this question, Josh. Why don't you answer it? When is the right time to buy a property?
The right time to buy a home is when it's the right time in your life. The same answer you give. If you're looking at making some money over the next 2 to 3 years by owning, that's not the right answer. But when you're saying, I'm settling down, I have a spouse, a fiance of some sort, we want to have kids, we want to put down roots and be somewhere for 5 to 7 years, we have stable income and employment, we're not likely to get transferred around the country, we've saved up a little bit of money, we have good credit. Those are sort of the life stages that are going to tell you it's time to look. So the question here is, where are we in the real estate cycle? So to put it in context, my house right now, God only knows what it's worth, but well north of 1.2, 1.3. When I paid $580 for it in 2003, I had the same story from my aunt and family members. Oh, you're crazy! You're paying $580. Just 3 years ago, those houses were $325,000, which was true. The absolute increases in home prices are not relevant to the discussion. If someone says, oh, home prices are too high. Well, why are they too high? Well, they're higher than they were before they crashed in 2008. Well, obviously they are. We're 13 years further down the line. Incomes are higher. Interest rates are lower. So if we look at a trend all the way back to the 70s, we are marginally above what that long-term trend looks like. So are we at the high end of home prices? Yeah. So what does that mean? Does it mean that they're going to crash? I mean, the favorite clickbait headline anywhere on YouTube, anywhere on the internet is housing crash. We saw it all last year. Every idiot on YouTube had the great 2020 housing crash, and then it was 2021, and next year we'll see it in 2022 because people will click and watch, and they can get paid for those videos.
Hold on, you can get paid for putting false information on YouTube?
Only if
What? Dude, this whole time I've been trying to provide good stuff. I'm done. You went out on me. I think
I
there
put
you go.
I put the phone on do not disturb, and it chose to still let calls in. So we'll just shut it off. But what we're saying is, where are we? What does that mean in terms of home values? So if we look at affordability, which takes into account incomes, which takes into account interest rates and percentage of household income that is allocated to housing payments, we are nowhere near the peak of 2008. And that's largely because rates are lower, incomes are higher. So what do we think is going to happen? Are our incomes going to continue increasing? For some people, they are. For a lot of people, they are. We look at the jobs numbers every week, and we see employers saying they have job openings they can't fill. That doesn't mean that it's likely that incomes are going to decrease. They're going to continue trending up. So now we say, what's going to happen with interest rates? Interest rates, as we've discussed 1,000 times on here, are likely to continue the trend that we've had for 40 years. 40 years, nothing has changed that. In that 40 years, our government has borrowed and borrowed and borrowed and borrowed, and is going to continue borrowing us into oblivion. We saw it today. I believe they started voting on their $3.5 trillion social stimulus, which I don't know what social stimulus is, or social infrastructure that they're working on. So when you look at that, the borrowing is going to continue, and excessive government borrowing pulls money away from productive purposes and keeps interest rates low. So as long as interest rates keep going lower, incomes for those that are employed and can buy homes go higher. You're going to see home prices going higher. And do I think we're going to see another year like we saw in the last year? No, this last year was really kind of insane, and we've talked about it on the show here, Jeb. The reasons for that: we had 2 years, or at least a year and a half worth of home buyers getting squeezed into the fourth quarter of last year and the first quarter of this year, and they just bid each other into oblivion. You know, you have a client that we're working with that she's got outbid on 4 or 5 properties, and they're all 20, 25, 30 plus bids. So the clickbait headlines are great to say, is the housing market flipping, or is it turning over? Are we finally seeing the crash? No, there's no crash coming. So we've talked about this before. Again, if you buy a $500,000 house with a minimum down loan, you're putting more than $1,000 a month towards principal. So at the end of the year, you've put $12,000 plus towards paying that loan down. If the home goes up 3%, it goes up $15,000. So do I think we're going to see 3, 4, 5% for the next 2, 3 years, which is about as far out as I would like to project? Yeah, I do. I wouldn't sit here and try and scare anyone that we're going to see a 14, 15% run up and you have to buy now or you're going to get priced out. But if you can afford, there are enough people in situations where their life stage is appropriate for them to buy a home and they have enough income and they can qualify. We see it every day with our buyers writing offers. There are a lot of buyers and there's not a lot of homes coming on the market, and that's not likely to change. So the only thing that causes a correction, there will not be a crash, but the only thing that causes a correction is a change in the supply-demand imbalance. So when you have your relatives telling you, don't buy, it's a terrible time to buy, wait till next year, ask them what magically happens to decrease demand and increase supply next year that would lead to lower prices. And the thing that happens, think about this. I was screaming from the mountaintops in 2010 to anyone who would listen, buy a house, buy a house, buy a house. It's absurd. They're cheaper. Like in Anaheim here in Southern California, you could buy a home with an FHA loan and your payment was less than what it cost to rent that home. So if you could come up with $10,000, $12,000, you could own a home for less than it took to rent, and no one wanted it. They're like, no, the market's going down. So if you think you're going to wait till next year, if we get a crash, you are going to be scared shitless and you will not buy into the market for 2, 3, 4, 5 years. So if you want to own a home, the market is nowhere near a peak, nowhere near a crash. There will be a correction at some point. It happens, and it will happen. I don't know, now 5 years from now, 6 years from now. You just need to say, what do I want for my life? Do I want to be a homeowner and have a home base where I can decorate the way I want, put in my own yard, put a garden in the backyard, put my kids in a school system where they're going to have the same neighbors and friends for the next 10, 15 years. There's reasons beyond just the financial reasons, but the financial reasons alone are still solid for the next several years.
No, great response. When it comes up again in like 10 minutes, I'll answer at that time and then you can take a break. So
cool.
Anyway, I digress, but no, great explanation and agree. We're on the same page, and it's not because Josh and I sit here and have this conversation offline. It's just that, we're both seeing it daily and You could say great minds think alike, but I mean, there's a lot of, great minds that we're both following that in different avenues, not the same people that have the same mindset as well, and a lot of data to back it up. Data to back it up. So anyway, we'll move on from that and get to some happy news here. So Surf City HB purchased a home in Cypress. Asking thoughts on Cypress. So Cypress is here in Orange County. Cypress is a great area, great school district. It's gone crazy, a lot like a lot of Southern California at the moment, because people getting priced out of these other markets are ending up in Cypress because of, the school district and the location and all of that good stuff. So I think you did well, but unfortunately you got to change your name now. So Surf City HB is now Cypress available to anyone else out there that is local. But no, congrats on the purchase. And Eric Gutierrez is digging the Lizard Queen. I'm not sure who the Lizard Queen is, so Eric, let us know in the comments below there. Anyway, let's see here. So, and Tony bought in Buena Park. So Buena Park is just beside it, as he mentioned there. And congrats to you guys. Let's see here. James thinks you should drink 805s to clear everything up. Ricky wants me to.
I've got a few in the garage. I should go grab them.
You should. That's the problem, I think. It's probably you stop drinking, and that's what the whole deal is.
So hold on. I didn't see Ricky's question till it popped up. This is a timely one for you, Jeb. What do you think about listing agents' etiquette for following up and doing what they say they're supposed to do or going to do?
Oof. I got a good video. I've got a video that I've written an outline. Let's be honest, there's no outline. There's a couple bullet points of things I want to talk about that I get on every day that bug me about real estate and real estate agents. But the majority of people that watch my channel aren't interested in that side of things. So I haven't put it out just because I feel like it's not really educational for those that I'm here for. But it's something that's back there that I want to do. But I feel like it's one of those that's going to come off heavy, and I'll get ridiculed for it. So anyway. All right. So this is a question. So Michael is he's a normal viewer. He's a regular viewer here on the channel, and he got to closing and calculations were off by nearly $7,000 at closing. Josh, so how can you get an estimated closing statement saying that you need to bring 12 grand in and then find out it's 5? Is that possible? If so, how can that sort of miscalculation happen? And wouldn't you have found out sooner than, I'm assuming it probably came back on the closing disclosure, but anyway, I'll let you jump in.
Yeah. So look at it. If I remember correctly, Michael's buying new construction, so he's been in escrow for a while. So some things can change through that process. And what I can say is lenders will always err on the side of caution when sending your initial disclosures out. Now, 5,000 versus 12,000, they're off by more than 100%. It's like 140% variance there between what it is. It should never be off that far. So when we see people get numbers that are crazy and then get surprised to the positive side in this one or to the negative side with a much bigger number at closing, it's usually one of two things. It's an idiot loan officer on the front end giving them numbers that they don't know how to calculate or how they're doing it. And it's not generally, so if you go back in the day to 2005, before everything went sideways, you had a good faith estimate, which basically, hey, I tried my best to give you real numbers. Now we have, since what, it's 2013 or 2015, that we have the new setup where you get a loan estimate, and the loan estimate sets the tolerances for what can change to the closing disclosure. So when you get your loan estimate, the lender themselves have sent that out, not the loan officer. So you're getting that from the lender, and if they're sending it out high, what they're doing is erring on the side of caution, because like we said, you have tolerances of how much your fees can change from the loan estimate to the closing disclosure. So with that, a lot of lenders will just choose to over-disclose. They over-disclose everything to the high side, and then they go, surprise, everything's much better at closing, and then there's no tolerance cure. Because all of the items on the loan estimate that have to be within a specific tolerance, so box A items, the items that we've talked about come from your lender or your broker directly, those have zero tolerance. They cannot change once your loan is locked. But the other items have tolerances generally about 10%. They cannot increase more than 10% if they're items that you cannot shop for. So again, we're talking 140% difference to the downside here. It seems extreme for them to have over disclosed that excessively. So I'm wondering if the change was from the initial loan estimate and figures throughout the process to the closing disclosure, or if it was from the initial figures that the loan officer had given you. Because a lot of loan officers just honestly, they don't know. They don't know how to calculate these figures, and they'll give you a best efforts number. Then when your loan gets opened, you get the loan estimate from the lender that sets your tolerances.
No, understood. Good stuff. So Christopher Yara has a question here. He's saying he got approved through a builder's lender, and they're saying he's only eligible for conventional, not USDA or FHA, because he sold his home while in forbearance. So I'm not sure if you're up to date on the guidelines for FHA and USDA with regards to coming out of forbearance, but my understanding is that there shouldn't be any issue.
Selling the home brings it current. It's just like refinancing it.
Correct.
You're bringing it current. I would be, again, I wouldn't bet my life on that, but my understanding is you're not going to have an issue with it. So I would absolutely talk to another lender or two in your area and see what information that they give you. And I would always recommend that when you're talking to a builder's lender anyways. So Jeb, we come up across this all the time. You are not going to be able to get an offer accepted from a builder without talking to their lender. From their perspective, they don't trust anyone else. You're going to put an application in. And then on top of that, they are most likely going to give you some incentive, which is generally design center credit, closing cost credit, something to use their lender. Now, the builder's lender's loans are usually very expensive. So from that perspective, I always say shop it. Get another number or two and compare and say, what is the premium I'm paying to use their lender, and is it more than offset by the credit? And the reason why the builders do that is they're simply trying to keep control and make sure they have a lender that's accountable to them and will do everything within their control to get it closed in a timely manner. So they're not necessarily the best lenders for having a breadth of programs or knowledge and expertise. They were selected by the builder for their ability to get deals closed on time once the builder has the home completed.
Got it. All right, good stuff. Eric asking the question, what's the difference between going FHA versus conventional? Now, we can ask Eric for more information in his situation, or you can just answer the question.
He put some addition. He actually started, he says his Vantage score is 750, but his FICO is 700. And he's saying that's the difference between going FHA versus conventional. So again, I even at 750, it does lean towards FHA. But yeah, Eric, you're 100% correct. And we all believe that the Vantage score is the more accurate score. And hopefully, eventually, we have the opportunity of using that as well with your mortgages.
All right. And so the biggest difference is down payment. I mean, honestly, like FHA, right, allowed to put a little bit less money down. You're able to have lower credit scores if needed, which is ultimately going to result in a lower monthly payment or a lower interest rate rather. But that there's several factors that play into that. So, the more details, the better, but talk to someone and have them run the numbers and you can get some accurate information. So.
Other than people with really high credit scores, meaning like 780 and above, the FHA will almost always have a lower monthly payment and lower cash to close. So you say, well, I always want that. I'm going to go that route. The benefit to going with the conventional loan is FHA not only has their monthly mortgage insurance, they have an upfront mortgage insurance premium. So you put 3.5% down, but they add 1.75% on top of that. They finance it, and that goes to the FHA for their mortgage insurance fund to cover the people that don't make their payments and default on their loans. So in essence, you're losing 1.75 right off the bat. That's really the only downside, and those are the numbers that we always want to go through with people, because sometimes it does make sense to take a slightly higher payment or come in with a little bit more at closing if it means you have a lower loan, especially the last couple of years with values going up so quickly. We want to see how quickly we can get rid of the mortgage insurance, and sometimes that happens more quickly with a conventional loan.
No, absolutely. Denise has a question here, and this is probably going to, a lot of people probably have a similar question, maybe not stated the exact same way, but is it better to buy a house or a home at $800,000 with a lower interest rate, 2 to 3%, or a lower priced home at $650,000 with a higher rate, 4 to 5%? I would say ideally, if you could get the lower priced home at a higher rate, the chances of rates coming back down and you actually being able to refinance it ends up being a better situation. So it depends, right? That scenario could be different for different people. It's not just a straight one-way answer. I would say compare the numbers. The 800,000 at a lower rate's probably going to work out to a lower monthly payment than the lower priced house at a higher rate, depending on how much you put down. Josh, you could probably do the calculation.
Well, here's the thing. So rates are what they are. So this question is actually, I think this is someone, we see a version of this question every 2-3 weeks on the show here. And it's someone overthinking the market as if these are both going to be options. Should I buy now at a 2.75 interest rate on an $800,000 home, or should I wait because rates will go up and we're going to see this big crash and I can get it at $650,000 at 4 or 5%? And if that's the question, I just don't think it's going to happen. $150,000 off of an $800,000 home is about a 20% correction, almost a 20% correction in values. That certainly could happen. I don't think it's likely to happen. And we've gone through this on the show for 40 years, going back to 1981. Rates have gone down, nowhere but down for a 1 to 2 year period. They may have trended up, but we've had a refinance boom or a refinance opportunity every 2 to 3 years for the last 40 years. So the reason what Jeb was saying there is, if you truly had those two options, you have a house, you can pay $800,000 for it and get a 2% mortgage, or you could pay $600,000 for it and get a 4% mortgage. You would always take the $650,000 purchase price and the 4% mortgage because we're in that long-term bull market in interest rates, and you'll be able to refinance it. You can refinance to a lower rate on your mortgage. You don't ever get to go back and renegotiate the price you paid for the home. But since those aren't an option, this question is generally someone thinking, hey, I'm going to be able to time the market, and this is the peak, so I'm not going to buy at the peak even though rates are amazing. I'm going to wait until they correct and I'll pay a little higher interest rate.
No, and you weren't supposed to answer that, right? I was getting the second one. Now you've done 2 and I've done none. It's
stop answering your damn phone unless we're getting offers accepted.
I got a home inspection at 5:30 and I'm getting messages asking me if I'm going to be there. So I'm like, no, I'm not. So I'm trying to figure this out just to make sure we're in good shape. Not my buyer, by the way. Anyway. Golden Gate here has a question. How low will the values drop? Oh boy. How low will the values drop? And is this just a retracement that will bounce back? Isn't the overall valuation driven by the money printing and institutions buying retail out? So I'm confused by the question.
The question assumes an answer. It assumes that values are dropping.
Well, I guess that's what I'm getting. How low will the values drop? And is this just a retracement? I haven't seen values really drop. So maybe in some markets out there, you're seeing lower prices. I haven't really heard that other than people commenting on videos and that sort of thing. I network with a lot of agents across the country that do a lot of business. And hearing similar things to Southern California, which is basically a little bit of slowing in the market. And is it because there's a little bit of increase in inventory? Is it because rates are higher? Is it because, I don't know, because I'm not seeing an increase in inventory really locally. I mean, I've seen a little bit, but it's been maintained. I mean, as of today in Orange County, we're back under 2,500 active homes on the market, right? You guys hear me talk about this each week. I mean, we went as high as, we went from 2,200 to 26. We've been hovering back and forth. Now we're back in the 2,400 range, the high 2,400 range. Huntington Beach, we're under 160 active homes on the market. So inventory is not increasing. So you're not really seeing this retracement in prices yet. And I don't think you're going to really see that unless something changes. Now, do understand, we're going to go real estate cyclical, right? It happens every year. Last year was a bit of an anomaly just because of the pandemic happening, COVID happening earlier in the first quarter, which kind of pushed the first quarter to the second quarter, second to the third to the fourth. And then the beginning of the year was a frenzy because a lot of those buyers that got priced out came in, or not priced out, didn't buy, got pushed into the new year. And so we started off this year crazy, but at some point this is going to normalize and we're going to have that cyclical market again, right? Which means, spring market is generally the hottest time of the year, leads into summer, which is, kind of a follow-up to that, when most of those properties that went into escrow in April, May, and June actually closed, July, August, whatever. And then you come into the fall winter market, which is, typically a time of the year when things slow down. That's going to happen. It's just a natural progression of the market. And in, states like Minnesota, Wisconsin, New York, some of these states where they get a lot of snow, it's cold out, the market slows naturally. You're going to see more of that this year. You've got a Delta variant, whatever you want to call it, playing a factor in here in Orange County. I think as of today, 5 o'clock.
I don't have it, Jeb. I don't have it.
Well, as of 5 o'clock, Josh doesn't have it, but I think we now have to wear a mask indoors again, is what I was told. This whole thing's going on, right? So where I'm getting at here is you're likely going to see the market slow a little bit, right? The numbers are they're not going to report well in some of these markets because it's going to say buyer demand's dropped. It may or may not say inventory is increasing depending on what people decide to do during this time, but it's a headline. Go ahead. Yeah.
Something that you just said, Jeb, and something that is the headline: market slowing, market turning over, market flipping. What does slowing mean? It's absolutely slowing. In February and March, I would go and every time I would see Jeb, I was ripping my hair out going, how are we going to get buyers?
Clearly not now. Look at how much you have.
Look at how beautiful it is. It's coming back in now. So how are we going to get someone into a home when there's 40 offers on every home and they're over and above what our buyer can? So it's slowing. It's slowing. It's slowing from absurd levels. It's not slow. It's not cold. Home prices aren't dropping. It's slowing, which is a very good thing for all of us because we can actually get buyers' offers accepted, but it's slowing from extremely high levels. So that's the important part. I didn't mean to cut you off. I'm just saying you hit the nail on the head. The market is slowing and people hear that and they go, fucking awesome. I get to, get a cheaper home. Like, no, you just don't have to pay as much over the top as you did last year.
No, agreed. So where I was going with that is you're going to see things slowing. People are going to take that and read the headline and say the market is slowing. There's going to be a lot of YouTube videos out there saying the market's slowing. It's going to slow. Again, look where we came from. Things have to normalize at some point. Now, if that means prices pull back a little bit, maybe they do in some markets. But what I'm telling you here at the moment is I'm not seeing a retracement in prices. A long way of getting to your answer, Golden Gate, but I'm not seeing a retracement in prices. In fact, the last 3 to 4 offers I've put out, last 4, in fact, actually more than that, have had multiple offers. One had 29 offers on it. One had, I forget the number on it. The one I'm in countering at the moment has 3 on it. And these are all going to sell above the asking price. So the fact that, there's not 50 offers on it, I'm happy, but it's still competitive. So I don't see a retracement. I don't think it's going to happen anytime soon, but you are going to see the market slow, but that doesn't mean prices are going to fall. That's it.
Jeb, look at the last part. So again, we tore apart the first part of the question. How low will values drop? Assumes they're already dropping. The second part, isn't the valuation driven by money printing and institutions buying retail out? No. The overall valuation is driven by supply and demand. Right. We have a ton of people who want to buy a home and can qualify to buy a home, and not many homes for them to buy relative to how many there are. It's a supply-demand equation, and until that changes, you will not see home values drop.
Well, and if we're going to talk about the overall valuation driven by money printing, hell, they're going to print more money in the next 2 to 3 years than we've ever printed ever. So if prices are being driven by that, you're going to see prices skyrocket. I mean, if that's the direction that we're going here, but it's not. So again, supply and demand, until something changes on that front and changes substantially, you're not going to see a big change in the overall market.
So again, not to beat a dead horse, but money printing. What do we talk about money printing? It's an increase in money supply. So you've seen M2 go to the moon. Well, M2 doesn't mean anything without velocity. Velocity of money is at rock bottom and dropping. So when we talk about that, the government's going to keep printing money. They're going to keep borrowing. The velocity of money is going to continue to decrease. Interest rates are going to go down. So when we look at that buoys home values as prices or interest rates that are really low are going to go absurdly low, and that will put a floor under any decrease in the market. As long as people have jobs, they can afford to buy homes, and there aren't enough homes for them to buy.
No, absolutely. All right, so we're moving on. We're getting away from that one. Happier times, Josh. What happens if I lock in a new build contract and before the home is finished, the market declines a bit? Will the builder adjust the sales price? No, chances are they will not. Unless for whatever reason they have a surplus of inventory on that, in that job or in that development, in that phase or what have you, and they're not selling, not having buyers come in at all, and you're potentially willing to walk away. Maybe, but these are businesses, right? This is a business. It's not an emotional sell. It's nothing about that, right? It's a business making a business transaction. And so if you don't want to move forward with it, chances are they're going to find somebody else or sit on it until somebody will, right? These people have the ability to do that. So I would think if the market declines, that would be the situation. But I mean, when are you closing? 5 years from now? Because if you're closing in the next 2 years, chances are you're not going to see a decline in those prices unless, there's some sort of overbuilding in that area.
And Jeb, isn't this another area where it's going to come back to the 117-page builder purchase agreement that's going to say exactly what happens, and it's going to cover their ass and not yours?
Right. No, yeah, absolutely. Yeah. It's probably laid out in that contract that you signed. And it's a very long contract, I assume, depending on the state where you're located and all of that good stuff. But builder contracts are there to protect the builder. And with that said, prices are usually not going to be adjusted regardless of the market. All right. Let's see. And let me see here.
We got a good one here, Jeb.
All right, let's hear it.
And mainly because of the picture. Jen has the best profile picture of any of us here on YouTube. It says, "Hi fellas, just heard of a shared mortgage appreciation loan for the first time. Could you offer any insight?" So a shared appreciation loan is where a third-party company invests with you. They help you come up with your down payment. And for that, they get a percentage of the appreciation on the home as it moves forward. So it can be an excellent way for someone who can't come up with a down payment to get into a property, to qualify for a more expensive property, because oftentimes they'll put up 20% down. That gets rid of mortgage insurance, reduces the monthly payment, makes it easier for you to afford the home. But then we're looking at, you're giving up half of your appreciation moving forward. And it's usually half. So you'd want to look at what they're offering. How much do they put up? How much of your appreciation do they want? So let's just say you buy a $500,000 home. They put 20% down. They're going to put $100,000 down for you. Now, if that home goes up $100,000, you're only getting 50% of that. And if now you say, hey, I owe the 100 to them plus the 50, I can get a $550,000 loan against that 600. You just have to realize you're going to be qualifying for a bigger loan because it's almost like a second mortgage. You can buy them out at some point in the future, but they're going to get not only the principal that they put in, the appreciation on the home moving forward. And Jeb, that kind of leads back to what we've been talking about here. Everyone here is asking, how do I protect myself because these home values are dropping? They're going to drop. Are they going to drop? Are they going to crash? Yet we have companies out there, what I would call the smart money, saying, hey, we'll put your down payment down for you, but we want half of your appreciation going forward. I don't think these companies are offering to put down payments for negative appreciation that's going to decrease in value.
Listen, and at the same time, I mean, this is like, I don't like talk crap on other YouTubers because, people have their own reason for posting different stuff and all that good stuff. But there's a YouTuber out there that's got a big following that talks about market crashes and all that crap all the time. And dude just bought like a $70 million worth of rental property in Texas. So, while talking about a housing market crash, let's be honest here. There's a lot of people looking to buy rental property and invest in real estate because they understand where it's going and the dynamics of it. Meanwhile, they're out there talking about crashes and all this other good stuff. So I don't know. Look at what people are doing and not what they're saying, right? My mentor would say more is caught than taught, right? Which means people are watching your actions more than they're listening to what you're saying. So, keep that in mind. If people are out there buying real estate, look at where, again, like Josh said, where's the smart money going? Why are all these companies going in? I mean, this is something that's crazy to me, and I still haven't figured this one quite out yet, and that's why I haven't talked about it on video. Is that I've seen two different scenarios where gone to price a property for a seller, and we've talked about a price, and we've talked about the high end of where that price is. And two times on two different scenarios, offers from Zillow that are $50,000 to $100,000 higher than I thought the price should even be, and making offers on those properties. So, I mean, if you looked at their financials, their latest earnings report, they didn't make any money on the real estate side. They made money from advertisement and realtors buying leads and all that good stuff. So they're not actually making money here. But I can't see why or how they're actually going out and throwing this kind of money at some of these properties. And in my opinion, overpaying for them unless they see the direction headed somewhere that is even crazier than I think could happen. But it's a whole different deal. I mean, there's a lot of these companies out there buying up these properties, and there's a lot of venture capital and a lot of money behind them doing it. So anyway, let's move on. So Andy Lewis said he reached out to me, serious buyer. So I don't know if that's a past tense comment or you just did it or what have you, but I don't think I have any information from you, Andy. So reach out to me again. My email and all that good stuff, my contact information's in the description of the video. So appreciate it. Let's see, Josh. So Juan Files 98. If I refinance, my interest rate would go up from 2.75 to 3.25 at the mortgage company I'm using. I'd get rid of MI, but then I'd have a higher payment. My MI is only $100 a month. Is it worth it? So a couple things going on here. Higher mortgage means higher potential tax write-off, whereas the mortgage insurance is not a tax write-off, right? But Josh, what are your thoughts on something like that going up?
So the mortgage insurance is tax deductible, but okay. It phases out. So it depends on income. Starts phasing out for people under $100,000. You can deduct the mortgage insurance. If you make more than $100,000, it phases out quickly. And at $110,000 household income, it's gone entirely. So the only benefit here would be to have a larger tax write-off. I would say with home values still going up, switching, getting out of $100 of mortgage insurance, but taking on a 0.5% higher interest rate, I would hold off. I mean, the other thing you can look at is you don't have to refinance to get rid of your mortgage insurance. If the appraised value will support it, you can go back to your current mortgage servicer and say, hey, I've made 24 months of payments, assuming you have. They can require you to make 24 months of payments. They can require you to get an appraisal to prove that you now have 20% equity in your home. But you can petition to have it removed if you have an on-time payment history, and you can get an appraisal supporting the value. So from this perspective, I would look at it. I wouldn't even propose to someone to take a higher mortgage payment to get rid of just $100 of mortgage insurance, which whether you can get rid of it today or 6 months from now or 3 years from now, you'll be able to get rid of it. So I certainly wouldn't take a 3.25 rate for the life of the loan just to get rid of mortgage insurance for a short period of time.
Yeah, and he asked a question prior to that, or gave more of the backstory, and you answered that as well. So good job there, Josh.
I read his mind.
Yeah, there we go. Daniel Quinones is 25% down the norm for investment properties. So I know you can put less down, but best rate is 25% down. Josh, why don't we just talk about that for a minute?
Well, best rate's going to be 40% down with Fannie and Freddie financing. That's beyond 40% down, you don't get any improvement. So that's sort of your sweet spot. If you're saying what down payment will get me the absolute best terms, it's 40%. On units, 2, 3, 4 units, you're looking at 25% down is going to be your requirement for Fannie and Freddie. If you're looking at a single family, you can do it as low as 15% down. We talked about this a couple of weeks ago. I had a client do one about 1.5 years ago. I looked at it and choked because the rate was so high and the mortgage insurance was so high. He was stoked to do it, and he was right, because now it's gone up $100,000 while he's been paying that escalated payment.
No, and Josh and I were talking prior to him coming on. This is a separate. I read this statement and thought about our conversation anyway. The transition wasn't great is where I was going with this, but they're wondering who the college kid is here with Josh, since he shaved his facial hair off. He's a young boy again.
Yeah.
Young boy with a mullet.
Exactly. We're working on it. We're working on the mullet. I'm going to have to trim the top to get the mullet.
All right. So Boz asked, have I seen many properties listed because the previous owners died of COVID? No, I'm not aware of any properties that are listed because people died of COVID. Typically, it's not disclosed how someone passed away or whatever, unless they passed away in the property, at which point then maybe there's some disclosure there. Other than that, we don't really know much about, family members, especially if something was passed to the heirs to sell or what have you. There's not a lot of information passed along there, but I'm sure some of the property out there is because of that. But I'm not seeing a lot of that.
Well, Jeb, in the listing, doesn't it typically say in the private remarks where only you agents can see it? I mean, they'll disclose it in the process if you get into escrow, but it'll say previous owner died on the property of natural causes. They're not going to say COVID, heart attack,
exactly.
cancer. They're going to say natural causes. Where they will get into it is there was a suicide on the property. We had the question last week, what about a stigmatized property with a murder-suicide on the property? That weird stuff will generally get listed or at least disclosed through the process, but stuff like this just kind of falls under that blanket natural causes.
Yeah, no, absolutely. Yeah. So to answer the question, not really. But I'm sure, again, I mean, I don't know what the numbers are of people that did pass away, but I'm sure some property out there is because of that. And
hey, we've got a fun question here. I like this one. It calls for speculation.
All right.
Says, I know you're not a fortune teller, but what do you think the loan limits will increase to in 2022 for high balance in Orange County? So for those of you that don't know, every year, the FHFA, which regulates Fannie Mae and Freddie Mac, they look and they say, okay, home prices went up this year, so we're going to increase the loan limits. And they look at their FHFA home price index, and I don't know exactly which month they look at it, but we always start looking because they'll announce it in November, first part of November, and we can start closing loans in early December, even though they technically don't go into play until 2022. But last year, I was playing with the numbers, and my guess was we were going to see about a 5 to 6% increase, and we got like a 7.5% increase based off of the FHFA index. I just pulled up the July figures year over year. So from May to May, they're calculating an 18% increase in home prices. So let's use our handy calculator here and say we got 548, 250 is the number, and they're going to go to 1.18 of that would be 646. So about 650 on your conforming loan limit, and then your high balance is 150% of that, puts us at about 970. And again, if I'm wrong, like I was last year, looking at a slightly lower number, it could be pushing $1 million. But I say safely high balance loans will be safely over 900,000 and could be as high as $1 million next year.
No, it's wild, man. Again, I'm aging myself as you could as well, but I remember when it was considerably lower, and it doesn't feel like it was that long ago that was the
when
case.
I started doing loans, it was $144,000, and there was no such thing as a high balance loan. If you needed to borrow $145,000, you were getting a jumbo loan.
Too funny. All right, guys. Ask a favor. If you guys are here, there's 240 something people watching. Hit the like button if you find value in the content in our question answering here. We devote 2 hours of our time. You can't even see the thumbs up because of the thing on there. Josh, what have you done? What have you done with the comment? We can't get it off. Anyway, if you find value in Josh and I being here, hit the thumbs up. It helps more people see it. Again, that's it's how we share good, knowledgeable information.
I got rid of your comment. I hope you're calm now.
Thank you. Jeez. All right, let's see what we got here. Let's move on. All right, condo townhome with an HOA versus single family home. Pros and cons. Josh, pros and cons on a single family versus condo.
Well, it largely comes down to the HOA and how it's run. I know you do a really good job with your clients of researching this. A lot of agents would just say, that's a good complex, let's write an offer. You want to look at the history of the HOA dues. How much have they gone up? You want to look at what you're getting for them. I forget, we had a client here recently, and I was like, that's a really nice complex with a lot of amenities. Actually, Jeb, it was your client that lives in where you live. So your homes, for what you guys pay, you have a ton of amenities in there. I've looked at others where you're like, you pay what? And you get what? You have a little janky exercise room and a pool. So those are the things you want to look at. You want to look at the budget, see how strong it is. You want to talk to some other homeowners in there and find out, is it a reasonable HOA or are they ridiculous? Some of these, like you leave a bike on your patio and they're going to give you a bunch of hassle. So in general, the benefit of a condo or a townhouse with an HOA is your price is going to be lower. Some of that is mitigated by the fact that you have to pay an HOA. You're giving up some of the autonomy of what you can do with your home and being subject to a homeowners association. You're also getting them to do some of the work that you would normally do with a home. So they can be great. They can be not so great.
You're on your own for a minute.
All right. So they can be great. They can be not so great, but really it needs to come down to um, how comfortable are you living in closer proximity to other people? How comfortable are you giving up some of the autonomy of you owning your own home and doing whatever you want with it? Your house, if you want to paint it bright yellow, no problem. If it's a condo or a townhome, the HOA is going to have some say in that. My home is a single family property. I own 2 properties with homeowners associations, and both of them are good, but not great. There's some things that you deal with that are a little bit of a pain in the butt, and you want to choke them out. But for both of those properties, the good outweighs the bad. The things that they do for us, the headaches they take away from us, offset anything that we give up with that. So that's what I would say. Just be aware of what you're giving up, and hopefully your realtor is going to, if you're considering something with an HOA, doing the research of checking out the documentation. If you get into escrow, you're going to get the budgets, the bylaws, the CC&Rs. Don't just sign off on it without reading through it. And I would definitely ask and find out what the history over the last 5 to 7 years is of the dues. Are they constantly increasing, or have they been fairly level? So that's what we would look at there. Are you coming back, Jeb, or am I going to pick another question here? Okay, here's actually a good one. Juan Files 98. I bought my house a year ago, put 5% down on a conventional loan at 2 3/4. I'm paying mortgage insurance. My house has built a lot of equity in a year. Do I need to refinance to get rid of MI? You probably do. In their contracts, they can generally require a 2-year payment history just to show that you are not a credit risk to them, but you can always reach out and ask. So if you think the value is there, by all means, check into it. Reach out to your lender, call the servicing department and say, hey, bought my house last year, think the values have gone up. What do I need to do to get rid of mortgage insurance? And in general, what they'll do is email or fax out to you a document that says exactly what the requirements are and what you would need to do to get rid of it. And it may tell you 1 year of timely payments, 2 years of timely payments, but you can absolutely ask the question now. And the good news is, with more equity in the property, you probably can get a rate close to that 2.75 right now and get rid of the mortgage insurance if the lender was not willing to get rid of the mortgage insurance with less than a 2-year payment history. So check with them, check with the local lender. If you're here in California, give me a call. We'd love to go through it. If you're outside of California, shoot me or Jeb an email. We'll connect you with an expert in your state that can go through that with you and give you the guidance that you need on it. Okay, this is a good question here. MG says, not buying related, but I did a cash out refi. Wanted to do another to get some more equity. Lender says to go with them again, I have to wait. Can I cash out refi somewhere else, or is there a limit? There is not a limit. You can refinance 2 weeks after doing your loan. Most likely, if it was a Fannie Mae or a Freddie Mac loan, what they are talking about is an early payoff penalty. So it's not a penalty to you as the borrower. It's a penalty to the lender for putting a loan on the books of Fannie Mae or Freddie Mac, and it pays off within 180 days. If so, they have to pay back all of their compensation and any lender credit that you receive to cover your closing costs. So they can actually end up having to pay back more than they made on the loan. So if that's the case there, MG, that you're within 180 days, that's probably why they're not super eager to do it. If you're getting close to 180 days, they should be able to work with you on that. We have a client here that I closed in the spring, and they've got more equity in the property. It's gone up in value. To use the new value for them, we have to wait 6 months. So that's the reason. But we also have the early payoff penalty if they were to try and do it before 6 months. So we are going to pull their credit here at the end of the month, get everything in place, and we can close at 181 days. So if you're close, you like your lender, see what you can do. If it's months off and they don't want to work with you, you should be able to go to another lender, but realize they're going to get stuck with a pretty hefty bill for your loan paying off in less than 181 days.
All right, I'm back. Sorry about that. Anyway.
We got along just fine without you.
You know what? I mean, at this point, like, all right. Anyway, yeah, trying to get some miscommunication taken care of. All right, so let's see. We had Jesse's asking a question here. Any update for us regarding the $15,000 first-time home buyer credit? No, not that I'm aware of. Nothing on that front. There is some information out there that's floating around, in part of this $3.5 trillion package that's this infrastructure package out there, but it's for affordable housing, and most of it's actually for renters. Has nothing really to do with home buyers in that case. So nothing new that I'm aware of at the moment.
I saw a 30 to 40 minute press conference with Maxine Waters. And in that, at no point did she mention homeowners. Everything they're talking about is helping renters. So we talk about equality and how big an impact homeownership has on building wealth and bridging that inequality gap. But everything that they are talking about is helping renters, which I get it. It's a good idea to help renters be able to afford a home, because some people homeownership is not a reality for them. But when that's your sole focus, you are exacerbating the problem and trying to create a situation where there's just people that are locked into being a renter forever. So it'll be interesting. I don't think that $15,000 credit is coming anytime soon, based off of everything that I see coming out of Washington, D.C. at this time, and especially in a really hot housing market. We need zero stimulus on the housing market at this time. Maybe when that big crash comes, maybe the YouTubers can tell us when we'll need the stimulus, Jeff.
They're going to, I'm sure. It's only a matter of time. All right. I don't know if you answered that one or not. Did you answer the question from Jose about refinancing after FHA? I wasn't listening to you.
Throw it up there. I know you were ignoring me.
Yeah. So just purchased a home with FHA. How soon can I refinance given the increase in the home's value? You actually have one of these. Is there benefit of refinancing with interest rates being this low? So Josh, talk about a situation. I think you might have mentioned it last week, but you and I had the conversation about a client that purchased 6-7 months ago using FHA. He called you, wants to refinance, saying that he thought he had 20% equity, and you were thinking he was crazy. And then it was actually accurate.
Did I close the loop for you? The appraisal came in yesterday. So it's Freddie Luna. He's a viewer here. He asked this same exact question here. And my answer to him was, hey, you're in San Diego County. Values have gone up. We're probably close, but I'd be surprised if you were all the way there. Not only did it get him under 80%, the value's gone up so much that we're under 75% on his home. And he just bought last November. So what are we talking? 10 months, home went up a ton. It went from 585 to 746. So $150,000, $160,000. So Jose, depending on where you're at, you'll want to know that the value is there, but check with a lender that has access to comparable sales or can get with the realtor that can go through it. When we looked at Freddie's deal, he told me his address. We looked it up, and there were 3 houses on his street that were smaller and or not as nice as his that sold for enough. So we were pretty darn confident the value was there. You would want to know that for yourself, but there's no need to wait. If somehow you got a massive discount, someone sold you a $400,000 house for $300,000, you could refinance it conventional after 6 months. So, and the reason why I'm saying so, the reason why 6 months is important there, Fannie and Freddie will, which would be your 2 options for buying without mortgage insurance, they will require you to use the purchase price for the home for the first 6 months. After 6 months, they will then go to the appraised value. But if you've hit 6 months and you think the value's there, get with someone that can run the numbers for you. If it looks like they're there, you can do it. And I guess the second piece I would say, and we talked about this with Freddie, before, I said, here's our worst case. We know we're at least at 85% or lower loan to value. He has excellent credit. The MI was going to be so tiny that either way, we were looking at saving like $250 or $350 a month between the 2 options. So Jose, even if you weren't able to completely eliminate the mortgage insurance, you can get it reduced a ton, because the FHA is at 0.85%, or if it's a high balance FHA over 625.5, it's at 1.05%. When you get down in that 85% loan to value range with a good credit score on a conventional, it's much more reasonable in that 0.15-ish range. So definitely worth checking out. Get with an expert. If you need one, reach out to me or Jeb. If you're in California, just shoot me a message and we'll look at the numbers and do the same things for you did with Freddie.
There you go. Chris has a question about having $1 million cash, wanting to buy and invest in Orange County. First time home buyer. Where would your advice be? It's tough, right? It's not a straightforward answer because it depends on what's important to you. And honestly, $1 million, you would think it gets you a lot. And quite frankly, it may or may not, depending on the area that you're in. So I would say, what's important to you, right? I mean, being near the beach, is that important to you? Do you work locally? Being close to that, is that important to you? Are you looking for an area that maybe has greater growth over time and not really care about where you are in Orange County? Like, there's a lot of factors that play into this. But there are, for the longest time, I've talked about this. One of the hidden gems in Orange County, if you will, was West Side Costa Mesa, right? It was just one of these areas that, the east side of Costa Mesa had been regentrified, if you will. A lot of new houses, restaurants, a lot of changes in that environment, and home prices shot up over time. And then West Side, right? It was undervalued for the longest time. And then over the last, I would say 5 to 7 years, you've seen a huge change in that market, redevelopment, just changes. And with that, property values have gone up. I still believe it's one of the undervalued markets in Orange County, just because of the location, the proximity to Newport Beach, the proximity to the beach, to restaurants, to the freeways. There's a lot of potential there. But it's something that could take another 10 years or so for that to really because there's still some pockets of it that aren't great, but that's a really good opportunity depending on what you're looking for. Other than that, it's hard to say, like, if there's a undervalued. I don't think there's really a lot of undervalued areas in Orange County at the moment, just because of where prices have gone. But find out what's important. And then from there, we can kind of narrow down some of these areas. But Orange County, I don't know how many cities in Orange County, Josh, 30 or so,
roughly
30 or so. So, I wish I could tell you that this is the city. But I think some of those questions that I asked initially would help better, put you in the right location versus just throwing out, a bunch of random cities that may or may not work because of one reason over another.
And I would answer the question a little differently. I wouldn't sit here and worry about, am I finding the up and coming area that's going to appreciate more than anything else? For the most part, Orange County is pretty homogenous. You're 100% correct that there are pockets that have outperformed. It's kind of hard to know them ahead of time. What I would say, if I had $1 million cash, I would look at buying a $2 to $3 million apartment building, 4 to 6 units, or we look, a couple of homes in the $600,000, $700,000, $800,000 range, put 50% down on each one of them, go in, get an ugly, beat up, nasty home and get it dialed in, perfect to rent. On the invest side, I want to acquire as many assets as possible, take advantage of the ridiculously low interest rates, because we're at some point, I don't know if it's 10 years, 15, 20 years down the line, there's going to be a reset, and interest rates won't always be this low. But for the foreseeable future, if you had $1 million, leverage it. I'm not saying, put 20% down on 5 properties, put 50% down on 2 or 3 properties, or 30 to 40 to 50% down on a big apartment building, 4 units, 6 units. So I guess it would be a small apartment building is what I would say.
Is this the great reset that you're talking about?
Yes, sir.
Oh my goodness. There's enough videos out there on that as well.
The problem is most of them have no idea what they're talking about, or when it's going to occur, or what it might possibly look like. We are a long ways away. It's going to happen. There's no option. Our government has concluded that you can borrow infinitely and never have any repercussions. At a certain point, you hit a wall and you can't repay it. And they're going to find out where that wall is. We're almost to 30 trillion. So it's not at 30, it's not at 35, it's not at 40. Is it at 50 trillion? Is it 100 trillion? Does it take 10 years? Does it take 20 years? There's smarter people than you and I who are thinking through this, and they're not making YouTube videos about
it. Just wait. Anyway, all right. Let's see here. Srinivasa. Jeb, if the builder is unable to show the correct lot size because of easement and PSE box in the corner lot, is there any option to demand the builder after AOS? I'm not sure. So I'm not sure why they wouldn't be able to show the correct lot size even with the easement. If the easement is on your property, then the property lines are still the same. That easement doesn't necessarily change your property lines. It just gives them access to the property, unless you're talking about an easement maybe behind the property or something that, but either way, I would think the builder should be able to determine the lot lines. I mean, this is a new one for me. And if there's a PE box in the corner lot, I'm not sure. Again, I'm not sure. Maybe if this is some things that they just have done because of the construction of the property, maybe it's interfering with the property until the construction is actually built. But I would think that they should be able to provide you with accurate information. In fact, I mean, they have to report it to the county, I would think. So that information needs to be correct. Josh, anything you want to add on that, or any insight?
Not really.
I mean, you could get a survey of the property, but that's going to cost, I mean, depending on where you're located, a pretty hefty amount of money. So I would suggest, getting the builder to provide the accurate information. And that's something they should provide. I mean, you need to know that when buying the property. All right. There's a compliment for you. I'm not going to click on that. We don't need any compliments in here for Josh. No, Freddie, who we mentioned a moment ago, same guy. Highly recommend Josh for lending options, refinancing through him. He was able to answer my questions, even with him being out of town. Gave me the loan estimate breakdown and explained it. And his own current lending situation, not even giving me a loan estimate breakdown, blah, blah, blah. So basically saying Josh is good at his job.
Well, you know what? Let me follow up on that, because it was kind of funny. So Freddie contacted his current lender, and what have I always said on here? I don't get offended when someone shops us. I think it gives us a point of reference, and it did in this instance. And what his lender did to him, I just saw from another borrower this morning. Just sent some numbers saying, "Here's your payment. No cash at closing." It was very vague and not detailed and broken down. If a lender is telling you things like no cash to close and just giving you a rate and a payment, be very careful. There's no reason on a refinance why they can't give you very exact numbers on what everything's going to look like. Again, I had the client this morning. She says, I talked to Amerisave and they said they can do 2.375. I said, awesome. Send me the figures they sent you. And all she said is, it says 2.375, my payment's $720. And it did have an APR. The APR was like 2.75%, which meant she was paying somewhere between 3 and 4 points to get the 2.375 rate. So again, it's just important that you do look around and know what you're looking for. If it feels like someone's trying to hide the details from you, they probably are. And unfortunately, a lot of lenders, they don't want to take the time. It takes a little bit of time to set up a file and show you a comparison of a couple of different ways to set up the loan and structure it. But it's important for you to be able to understand and know what's going to be best for you. So appreciate Freddie, appreciate him for looking and showing us the other numbers and giving us the opportunity. And congratulations, he's in a great spot. That's probably the biggest increase I've seen in a 10-month period on at least on a percentage basis for a property.
All right. So Soul Steading says, what's going on with rural markets looking at buying in the next 6 months? So probably aware of this, but here in Southern California, we don't really have a lot of markets that are deemed rural, right? In where we're located. I mean, within 50 miles of here, I mean, there's nothing, I mean, maybe even further than that at the moment. So I'm not really up to date on what's happening in most of those markets. Josh probably isn't either. I know he doesn't do a lot of rural lending, but what I can see happening from the outside in is that people are, looking for more land, looking for opportunities to build, looking for, an opportunity to get into the housing market where prices have gone, and it might be less expensive to build in some of these cases. So that's probably putting some stress on some of these rural markets, depending on where you're located. Now, if you're talking like the middle of the desert, probably not, but I'm from North Carolina originally, grew up, that's where I grew up my entire life. And I mean, where I'm from, my cousin just put a house on the market, sold in the first day, for above the asking price and that sort of thing. So, I mean, those markets are considered rural and things are selling quickly. So, I think it's not as crazy as like urban markets, but there's still some demand depending on where you're located.
Jeb, you have no idea how hard it was for me to bite my tongue with all the rural South jokes I could have just thrown out there. It was really, really hard.
Oh. Dude, do them. We'll just lose people here, bro. You'll be offending people like you offended me at this first comment. Let's go back up. I can't even get up there. They won't let me.
They go
'Cause-
away after a while. I learned that last week. So hey, here's kind of a follow up. So Brittany Blake follows up on the other question. Well, what if my PMI is $275 to $300? Is it worth taking on a higher interest rate? So most likely, if you have the higher mortgage insurance, you have a larger loan amount. So the increase in the interest rate is going to also offset that. But this falls back, Brittany, to what I always say is numbers never lie. Talk to a lender, talk to a couple of lenders, have them get you a loan comparison of a couple different options of how to structure it. The numbers never lie. When you look at it on paper, it should tell you, obviously, yes, this makes sense for me to do, or no, this does not make sense for me to do. So then I also wanted to follow up on that. We have a commenter over here that wanted to answer Brittany's question. So whether you're watching YouTube videos or reading comments online, be careful what you read and who you're actually considering an expert, because this gentleman says, MI will automatically fall off once your equity is greater than 20%. If you're close and you want your property appraised, don't do it. This is not true. On an FHA loan, your mortgage insurance will never go away. On a conventional loan, your mortgage insurance will automatically terminate at 78% of the original loan balance. So even if you put 10% down, you're going to have that mortgage insurance until that pays down to 78% of your original loan, which takes about 10 years. So I understand wanting to get rid of mortgage insurance. Values have gone up. Rates should be pretty similar to where they were this time last year. They've been fluctuating. We'll go through that here in a little bit. But again, just be careful what you're reading, who you're listening to, and make sure you actually get someone that knows what they're talking about.
There you go. Michelle Ken, super chat. Thank you, Michelle. Appreciate that. What are your thoughts on waiving the loan contingency if you're a well-qualified buyer looking for ways to be more competitive? So I think waiving the loan contingency is actually okay. If you have gone and done the proper documentation up front, you've been fully pre-approved with your lender, and your lender's given it the go-ahead, right? So if I'm in this situation, I have a buyer looking to be more competitive, we're thinking about waiving some of these things. I talked to Josh, hey, if he's doing the loan clearly, and say, look, this is, and he's like, yeah, dude, the loan's fine. There's not going to be any issues there. Okay. We're going to waive that contingency. But keep in mind, we're keeping other contingencies in place just in case, right? So we're not talking about waiving everything here. But if you're well qualified, you've gone through the process, you've provided all the documentation, someone's actually reviewed it, looked at it, you trust their judgment, I think it's okay to waive the loan contingency in order to be competitive. And go ahead, Josh. I know you're going to jump in there.
I'm at a little bit of an advantage on this because we're working with Michelle. I know what her numbers are. So I would double down for her with what you said. We had Lupe in January, February that fought through 30 something offers to get a property for her and her husband in the
21st offer went into escrow.
The 21st offer in the worst part of that market. Michelle I don't think has written quite that many. She's a little more discerning in terms of what they're writing offers on. It's taken a while. And I thought we had one of the coolest little houses about 6-8 weeks ago and just missed out on it. So again, that's someone that you could ask if you want to hear about how much the market is cooling and how it's rolling over and going to crash. There's lots of buyers, and she's in a higher price range, and still lots of buyers in that price range.
No, absolutely. All right, I'm seeing it every day. In fact, yeah, I mean, this is a follow up to the question a moment ago. Kate saying she's in a rural area and it's crazy there. Put in 5 offers. But finally got her offer accepted within the day it was posted in the Midwest. So she's put in a couple of offers, finally got one accepted. In fact, I know she commented on another video that I did and had mentioned that as well. So congrats on that. Al Buggy saying, can you buy while on forbearance or sell while on forbearance and buy? So Josh, what are the guidelines currently on? I know you can't buy while currently in forbearance. That loan needs to be brought current. I'm assuming from a lending standpoint, right? But if you're planning on getting rid of that property anyway, you could sell that property and purchase something else. But what happens if it's not actually sold yet and you're going through the lending process and it shows in forbearance?
This is truly one that's a gray area, and I can't give you definitively the answer. So Al Buggy, shoot one of us an email. I would love to get you the right answer on this. My gut is you can sell because again, you're bringing the loan current through the payoff. So if we can show that, you should be okay. But the way the guidelines are written in terms of refinancing, and we had another question here. Someone was asking, coming out of forbearance. Well, what does coming out of forbearance mean? It means that we have to have made 3 on-time payments. So either you bring it current, or you get into a repayment agreement where they say, hey, we're going to tack the forbearance amount on the back of the loan, and you make at least 3 on-time payments. So in this situation, if you sell while you're in forbearance, you haven't made those 3 on-time payments. So again, it's just not a scenario I've come up with. We do a lot of loans, but I just haven't had this scenario come up yet. And I would love to get you the right answer. So shoot us an email. Jeb, can you throw up our emails? You want to just hold off till the end?
I'll do it here in just a second. Just find us something, and I'll throw it up here in just a minute.
So okay, yeah, let's throw this in here. I like this one, and you're gonna have some input on this one. So Burn It Up, which I believe appears to be a Bernie Sanders reference. So we'll see about that. Hello both. Thanks for all the awesome information.
You just keep reading. Oh, did I take off the one you're reading? Sorry.
No, it's fine. No, just leave that up there. So what are your thoughts on manufactured homes? Seems that we're priced out, and this is our other option. Now, here is the important part. Buying a home cash, rent the land. So they're talking about buying a manufactured home and putting it in a park where you do not own the land. So you don't technically own real estate. That manufactured home can be a very nice place to live. I don't know if any of you guys have seen manufactured homes. You know, there's the joke of, oh, you live in a double wide, and you say, well, have you seen them? There's some really, really nice double wides that most people, it would be an upgrade from where they're living. So I have no problem with buying a manufactured home for a great place to live, but it's considered personal property if you don't own the land that it is permanently attached to. So if you are in an area where land is plentiful and you can buy land and put a nice manufactured home on land that you own and get a mortgage for both of them, I have no problem with that whatsoever. I'm just not a fan of renting in a park. If you talk about real estate investors, one of the biggest for bigger investors that actually have a lot of money available to them, one of the most profitable things they can do is buying mobile home parks, because those rents, they go up. It's just like renting an apartment. You're going to be subject to those rents going up forever, and you're never going to get to the point where it goes away. So it can be a lower cost of putting a roof over your head, and the manufactured home may be very
earlier on a video, actually earlier today, where they asked a similar question. And my response to them was something similar, but I said, listen, I mean, what are your options? If your options aren't, because they talked about maybe not wanting to buy a mobile home because it was a mobile home or manufactured or modular, however you want to classify it, because of what it was. And I said, well, what are your options? Can you buy something in your market, for that price? Can you buy a single family? Can you buy a condo? If not, and you want your own property, that's your option. And if you don't want that, what's it going to cost you to go rent something? So in this case, you own something. In that, I believe they were buying the land in that scenario, but it's not for everyone. You're not going to get the appreciation that you would on a single family home, or a condo in many cases, but it's something you own. It's yours, it's not bad. We don't deal with a lot of them out here in Southern California. In fact, most of the ones that we do deal with are actually in parks where they're rented, where the land is rented. You own the unit. And I'll tell you, some of these rents, I mean, I see people that are interested in them all the time, and until they find out how much the actual lease is per month. And some of these by the beach, $2,100, $2,200 a month in a lease. I mean, you can buy a place, but at $2,200, $2,300 a month in a lease, I mean, it's basically like renting. So, just got to weigh the pros and cons and see if it's right for your scenario, your situation. All right.
Here, and it leads into the part of the show where we generally talk about interest rates. What do you think about that?
Talk about it. Yeah, let's talk about it.
So Tanyisha Wilson says, this is an add-on to my earlier question. Do you guys think interest rates will be the same or better this time next year? If I were a betting man, I would say they'll be lower. I don't know that they'll be significantly lower, but let's talk about what happened in the last week for interest rates. We had got rates pretty much back to their all-time lows, or very, very close to it. 10-year Treasury was back down, mortgages were down. We were in that 2.75 for super well-qualified borrowers, even 2.625 on a conventional loan with 0 points and 0 lender fees. And we gave a bunch of that back in the last week. And really, when you look bigger picture, the technicals say that we should see better interest rates, but the market is looking and saying, we just passed the Senate passed the smaller stimulus bill. They're now talking about the much bigger $3.5 trillion stimulus bill. We're talking about potentially tapering government purchases of U.S. Treasuries and mortgage-backed securities, probably not till the first quarter of next year. So all those things introduce uncertainty. So when you have uncertainty, things can kind of go in a different direction for a period of time. The longer term trend for lower interest rates is still in place. Rates are still very, very good as of today. So if it makes sense for you to refinance, or if you're in escrow on a 30-day escrow, it's probably appropriate to lock right now. But if we want to look forward 6 months, 12 months, my guess would be 60-40 that rates will be better than they are right now. Jeb and I answered this question. Everyone likes to ask in December, what's the forecast for next year? And we thought rates could go as high as 3.375, but would probably stay in a similar range. And they went up to about 3.25. And then started moderating after March. And here we are for your government loans, definitely under 3%, most in that 2.25 to 2.5 range. And for your Fannie Mae, Freddie Mac loans, well-qualified borrowers in that 2.75, 2.875, 2.99 range, depending on credit scores, down payment, condo versus single-family residence. So interest rates are still really good. Right now, we have a locking bias for the short term. I think we'll hit a technical bottom in terms of bond prices and interest rates being higher sometime here in the next 2, 4, 6 weeks, and then we can look for the next leg up in bond prices, which will lead interest rates lower. But long way of saying, rates are really, really good. If it makes sense for you to borrow now, I wouldn't necessarily hold off. Again, we always talk about not paying a bunch of points and a bunch of fees for your loans, because as rates move lower, which they inevitably do, you're then free to take advantage of them moving lower.
All right. No, good stuff. Great update. So Ryan had a question here, and he's saying Louisiana new construction home at $260,000. Lender is offering a MBR program, soft second mortgage, bringing 4% of closing purchase to closing. So bringing 4% down payment, the way I read it. In-house builder lenders only offering 4K at closing. Please help. So, do you understand the question there, Josh?
A little bit.
Loan.
Yeah, so a little bit of it. So bringing 4% to closing. The thing that I would focus on here, most assistance programs, whether they're county, state, he's talking about soft second. It's a silent second. You're not going to make payments on it, or you have a very low interest rate. Most times you're going to have no payment, very low or no interest rate, but it's not free money. They're putting a lien against your property. Now, I don't know this program. Some of the programs, after 3 years, 5 years, 7 years, they'll go away. The second will be forgiven. In that case, it would lead you more towards taking that program. But looking at the builder's lender, they're offering $4,000 at closing. You really have to look at them side by side. What do you owe when you're done, including the second mortgage, whether you're making payments on it or not? Is it ever forgiven? And how much do I have to come to the table with? So what's my monthly payment? How much cash do I come to the table with? And like we were talking about earlier with an FHA loan where you have a bigger loan amount, what do I actually owe? So again, just look at those 3 questions. Get the numbers from your current lender, get the numbers from the builder's lender. What's my monthly payment? How much do I bring to the closing table? What's my total loan amount that will have to be repaid at some point when I sell the home or refinance? That would be how I would make the decision.
All right. S. Lim has a good question here. Is it bad to buy a lot that has a storm drainage easement in your backyard? Does it make it harder to sell in the future? So it depends. I mean, here's the thing. If those are prevalent in the area, in the market that you're in, then probably less of an issue with regards to selling it. If it's a unique situation in an area, right, where there's only one or a couple that have it versus, everyone else that doesn't, then yeah, I mean, it may make it harder to sell. I mean, things like, backing to a freeway, backing to a flood, canal, drainage canal, power lines, any of these things for one person might be a problem, whereas for someone else, it's not. But what I tell clients all the time when buying property is understand while it's not your intent necessarily to sell this property anytime in the future or in the near future, think about when you do go to sell it, this could be a problem for some people. Busy streets, drainage canals, power lines, these sorts of things, because, and it doesn't necessarily mean that you're going to get a lot less money for the property. It just means you're going to have less interested buyers in that property, right? So if you had a pool of 100 buyers that would be interested in a property that didn't have that, you're going to have less because you do have that sort of thing. And maybe that does result in less money for the property because less demand. In this environment, what I'm seeing right now is people that have properties that have, in my opinion, I can't think of the word, we'll just say issues, if you will, because they back to freeways, they back to major streets, I see these properties, a lot of people selling properties in this market that are like that, and they're getting top dollar for them. Even with them having these, quote unquote issues, just because of where demand is, where inventory is in a normal market where it was a little bit more balanced, these properties would take longer to sell and likely sell for a little bit less because of those issues. So I think it's going to depend on the market and depend on the buyer. But to go back to your question, yes, it could be. It's hard to say because I don't know your market. And I would go back to, maybe talking to your agent and asking that question and getting their thoughts on it. If you were my client, it would be an honest conversation, right? Everybody thinks, Jeb, you're a realtor. You're just going to sell a property. No, I want to sell you the right property. I want you to be a happy client. I don't want to find out in a month that you don't like your property or there was something that you didn't like about it. And you never discussed it. So, as long as you trust your agent, have that conversation and hopefully you get the information you need from it. Right. Let's see here. What are the best banks to refinance my FHA loan to a conventional loan? Wanted to get rid of PMI, but refinance is the only way. So we talk about this often, right? Josh is going to be a bit biased because he's a broker. Brokers are better, right? But here's the deal. Get a quote. Get a couple of quotes for people to talk about refinancing, right? Maybe go to whoever you bank with. Maybe you bank with Bank of America, Wells Fargo. Maybe you're on the East Coast and it's BB&T or one of these guys. Go in, get a quote to refinance, and then also talk to a broker. Talk to somebody in your market that's a broker. And if you don't have one, there's a link in the description of this video that you can click on. We'll throw it up here at the end as well. And we'll refer you to somebody in a market that does business like Josh does, but then compare the two, have them run the numbers, compare the communication, compare all of that information and decide the direction you want to go. And I would say typically you're going to lean towards the broker just because it's a better experience and it's going to end up costing you less money in most cases. But Josh, why don't you throw your advertisement on there?
Yeah, no, we talk about this all the time. The most important thing is not the channel of who the person that you're doing the loan with works for. It's, are they an expert and are their terms competitive? I was at an event last week with a buddy of Jeb and I's, and he works for a big direct lender. He's awesome at what he does. He would do a great job for you and you would get good terms. As a broker, we're going to get you a little lower costs, slightly lower interest rate. But when you say what banks, if you go into a bank, you're talking to a glorified bank teller. So from that perspective, you're not getting an expert. There are some mortgage lenders. Jeb, you know some of the big banks that are dealing extensively in jumbo stuff, they have loan officers that work on that. But if you just call up a bank, they have a call center. Or if you walk into the branch, they have someone that waits there every day for the roast duck to fly into his mouth. He's not a mortgage expert. So talk to a couple people in a few different channels. If you feel like you want to talk to a bank, but talk to a broker, talk to a direct lender. And what does that mean? It's someone that works for a mortgage bank. So they don't take deposits. They don't have checking accounts. They just make mortgages, and then they sell those mortgages into the secondary market. In those channels, direct lenders, brokers are where you're going to find the experts. And the only way you're going to know is if you talk to a couple people to have a point of reference to compare to.
So Will saying he's a home builder. Most of what these guys are saying is nonsense. So Will, He says he's got people paying him $200,000 to build them $600,000 homes.
Congratulations.
Yeah.
What does that have to do with any questions that have been answered today?
Not sure, but I just thought I'd throw him up there so we can make fun of him or something. Anyway,
if anyone needs a home built, call Will. He can do it for $200,000 for a $600,000 home.
There you go. And actually, Will, the smart guy here, wouldn't be building the homes. He'd be paying to have the houses built. Keep that in mind. You can build these houses and sell them for $600,000. That's where you should be on this situation, not the one building them. Just saying. Anyway, we're going to move on. Any thoughts on Bitcoin, Josh? Do you have any opinions on Bitcoin?
No.
Being classified as real property by the IRS.
Again, this is an area of ignorance for me. So I read articles of smart people that follow it, and I have smart people that say it's silly and it's going to go away, and I have smart people that say it's going to $500,000. You got to get in now.
Yeah, there's also people out there saying that the Dow is going to go to $1 and that homes are going to crash, and that, like, again, I mean, there's so much out there, right? I get the, no, I don't. I'm lying. I don't understand how it works. I have buddies that run funds that have tried to explain it to me in simple layman's terms where like anybody could understand it. And when they explain it, it makes a little bit of sense. But then after the conversation's over, I try to explain what they explained to me, and it makes absolutely no sense when I say it. And therefore I can't get behind it, man. So I own no crypto. All my money is in equities and stocks. And so I don't mess with crypto just because, quite frankly, I can't explain it. If I can't explain it, I can't invest in it. I mean, it sounds like a Warren Buffett thing to say, but it really is. I mean, until I can explain to somebody how it legitimately works, then I can't get behind it. I know there's a lot of smart people that invest in it. And yeah, I wish I could tell you that I did, but I don't. Anyway, so how that's tied to real estate in your question, I can't really answer that for you.
Let's go back. Burn it up. Came back with a follow up. Thanks both. Right. I'll just move to the high desert. That's another option. So, high desert. Do I have it right? High desert is like Palmdale, Lancaster, and then the low desert is like Victorville, out that area.
I think you're right.
Okay. I don't bet my life on it, but I think it's right. We've had multiple clients, multiple viewers of the show here go through Jeb and got connected with a great realtor out in that area. And I would say, I mean, in a perfect world, we all can buy wherever we live right now. As a renter, we can buy something in that neighborhood and afford it, no problem. So from what you're telling us, hey, manufactured home in a park where I don't own the land, or go to the high desert and own a home where I own the whole thing, I would absolutely lean towards going to the high desert. It's a more affordable area. For those of you who don't know, it's probably 45 minutes to an hour outside of Los Angeles when there's not traffic. So you have a little bit of a commute for work and whatnot if you actually still have to go into the office or the place of work. But between those two, I mean, they're both a compromise from what you would like in a perfect world. But with home prices up, I would lean more towards the more affordable option a little bit further out. Okay,
there we go. Brian Espinoza has a comment here, but it looks like, does it follow up to something else that he mentioned earlier?
I went back and looked. I couldn't find.
Yeah. So Brian, I feel like part of your question's not there. So maybe put it in there so that we have the full question and can answer it. Josh, where did Michael's comment go? Josh with the baby face. Were you a member of the Backstreet Boys back in the day?
I'm too old for that. I was NKOTB, bro. Come on.
NKOTB. Jesus.
By the way,
that wasn't even a thing.
Bringing it full circle, did you see that one of the new kids has a show on HGTV where he renovates old barns?
No, barn dominiums?
No barn dominiums, like 200-year-old barns in Massachusetts. And thankfully, he has a designer because he has no eye for design whatsoever. But they do nice work. There've been some bitchin' barns, like farmhouses with big barns that, like, you can tell these are really rich people. There's like $2-3 million farm barn things, and we don't have any of that history here in California. Some of these are like, yeah, this was built in 1785. I'm like, I don't know that I want to take on a renovation of a 1785 barn.
Dude, that sounds like, watching Norm with my dad, like as a kid, watching This Old House and, watching them restore a house built from the 1700s and like tongue and groove, connections in the house, no nails, crazy stuff. Anyway, let's see. Dylan had a question here. What advice do you have for a first time VA loan user? So, Josh, a VA veterans, right? One of the benefits they have if they've, served the proper time with regards to eligibility is they have the ability to purchase a home with zero money down. And it's one of the big benefits of being a veteran. What would you advise somebody that's just going through that process if they're looking to get a loan? Maybe before having a conversation, is there something they need to do with regards to eligibility, or do you recommend having a conversation first?
Not really, because it was a pain in the butt. Back in the 90s, you would have to go down to the VA, stand in line, or mail in your form and wait weeks to get your certificate of eligibility back. 80-90% of the time, we can get them online immediately for you. So we just talked about, should you go to a bank or a broker or a direct lender? On a government loan, a VA or an FHA loan, you are almost definitely going to get the best terms from a broker. For whatever reason, banks aren't interested in making government loans, so they don't offer great terms on them. And direct lenders see them as a big profit center to offset the lower margins they have on their conventional loans. So again, you talk to Jeb and I's buddy on a conventional loan, his numbers are going to be pretty close to mine. We'll be cheaper, but he's going to be pretty close. If we talk on an FHA or a VA loan, they're going to be massively different. So I would absolutely make sure you talk to a broker, and not just any broker. Make sure you're talking to someone with experience on the VA loan. They're slightly different. They're not massively different than an FHA or a Fannie Mae loan, but they're different. And you need to know the process. You need to know to get that certificate of eligibility up front. I actually have had 2 deals this year where someone called us, panicked, trying to save their deal that was going to fall apart because they ended up not being eligible. So they thought, hey, they were obviously in the service. They didn't have enough service time. One was in the reserves. One said their records got lost, and their lender didn't insist before they wrote an offer to have that certificate of eligibility. So above and beyond all that, the most important thing, do not Google and see Veterans United or Navy Federal Credit Union or any of the other places that say they're the #1 VA lender. They do a ton of them, and they just steal from veterans blind. You will get terrible terms, and they will have a bunch of overlays, meaning additional guidelines above and beyond what VA themselves actually allow. So again, talk to a few people, but talk to a broker. Ask them, hey, in the last year, how many VA loans have you done? If they're not doing a couple VA loans a month, they probably don't know the guidelines that well and know the program. And you would be surprised. There's a lot of lenders that only do conventional loans, and an FHA or a VA, they can do them, but they're not necessarily an expert in those loan programs. So that would be the best advice for a veteran. And it's a great loan program. Don't let anyone talk you out of it. Jeb, from the real estate side, we know it is harder to get a VA offer accepted with the zero down, but don't let anyone talk you out of using that benefit, because it's a great loan program.
No, yeah. I mean, depending on where you're located, they're going to be a little bit more prevalent, right? If you're in an area that has a huge, maybe a base or something, a lot more VA loans are going to happen in those markets, just because it's the natural progression of people, in that area buying and being able to use that benefit. And so those markets might be a little bit easier to get them accepted. If you're in a market where they're not quite as prevalent, it might take you a little bit more time. But I will tell you, people want to help veterans, right? I mean, they do. So, make it aware that, of your service. I mean, and make sure that your lender has a conversation with the listing agent on the other side, discussing the loan, talking about qualifications, that sort of thing, helping ease the pain, right? I mean, a lot of you guys are also watch Jennifer Beeston's channel, and she talks a lot about VA loans on her channel. And, one of the things when her and I had a conversation on video, one of the things she talked about was that's one, she posted a video or something on Instagram over one weekend where she had like 6 or 7 VA offers accepted. And so I had that conversation with you, and she said, the one thing I do is I reach out and I have that conversation with the other side to let them know that this is a good loan, and that these, just because they're putting zero money down doesn't mean they don't have any money. It just means they're using the benefit that they're allowed to use. And once you can explain that and convey that and people, want to help you, you can get, through that barrier. So again, like Josh said, don't let someone tell you that you shouldn't use it or you can't use it in this market. You absolutely can. It just might take a little bit more hand holding to get through it. But if you've been in the service, you can deal with a couple offers. So and with that said, thank you for your service. We appreciate it.
Jeb, I got a trick question here.
All right.
Richard Moharo wants to know, what are some good brokers in the Los Angeles area?
I thought you were going to ask me how Will was able to get lumber so cheap to build $200,000 homes. I thought that was going to be the trick question.
Michael asked him.
I know, and I appreciate Michael for asking that question because I was going to go buy some.
You know my theory. Don't feed the trolls. Let them go back on.
No, I like feeding them. We're just going to start feeding them. I think it's going to be more fun. The show's going to go better if we do that.
So Ricardo, I owe you an apology. My eyesight is clearly failing me. I said Richard Moharo. It's Ricardo Moharo. So Ricardo,
he probably goes by Richard.
Well, maybe. We're in Orange County. We help people throughout the state of California. Reach out, shoot me an email. We can definitely run through some numbers. And again, like Freddie said earlier, check a couple different places. I think if you talk to us and we run the numbers, if you find something better or someone you're more comfortable with, we at least know you're in good hands.
No, absolutely. And if you need an agent up there too, I don't work Los Angeles, but I know a handful of great agents in that market, depending on where you're looking to buy, that can guide you in the right direction. Let's see here. Josh, are you familiar with the Bank of America grants at all?
No. And I know a couple people have reached out. You did a video on it. I think Kyle did.
No, I never did one.
You never did.
I did not.
Kyle did a video on it. So a few people have reached out and they said, it seems to be a good program. A few of them were able to get approved for it, but there were some strings attached where it seemed like no one was really moving forward with it. The biggest downside I could see is you have to get your loan from Bank of America. It's going to be a slow and tedious process, and you're going to deal with someone that is essentially a bank teller. But if they're giving you free money, isn't it like 17 grand? It's not an insignificant amount of money.
You get a 15 or 17.5 or something. 17.5 maybe.
It's a lot of money. So if you can get it, then by all means, do it.
All right, cool. There you go. Let's see. Urwi, Uruguay. I'm interested in a home that needs renovations. My offer wasn't accepted, I think, because it was too low. I really like the house. Is it wise to submit a better offer? The house has no offer. So, it's hard to say, right? I mean, I wouldn't tell you to submit more than you think it's worth or more that you're comfortable paying. You got to factor those renovations into the property, right? So if you're looking at that property and you're looking at what you're going to pay for it and what you're going to put into it, what's it going to be worth at the end of the day? Is there a return on the cash that you're going to put into it? And actually, are you going to profit, or is it going to become something that maybe you're not necessarily looking for profit, but it's going to be a house that meets what you want it to meet when those renovations are done? In that case, maybe it's worth paying a little bit more to get that property in a market where things are crazy. At the same time, you could use something maybe like a 203K, some other type of financing that allows you to actually build the renovations of that that property into a loan, leaves you less cash out of pocket, maybe a little bit more to put down on that loan, depending on how you structure it, and might put you in a better position financially. And if it doesn't have offers on it, maybe that's the way to go in this environment. And then when it's done, if there's additional equity there, maybe you can refinance it into a conventional loan. But Josh, what do you think about something like that in this market?
It's hard to get renovation loan offers accepted because they take longer to process. Everyone's asking, well, how quick can you close? And a renovation loan is going to be probably 45 days to close if we're lucky. But if this house has no offers and the thing that's holding you back is the renovations or needing to come up with the cost, that might be a compromise there, and you can get them a little bit more money and they give you the time to do your renovation loan. And you have the FHA 203K, you have the home style renovation loan for a Fannie Mae loan, depending on where your qualifications fall in. So a number of options with that. But yeah, what you said is 100% correct. I mean, the value of a home is what the market will bear. So he's put it up. No one's made him an offer. You made him an offer and he rejected it. Until someone makes him a higher offer, That doesn't mean that the home is worth more than that, or it would be wise to offer more. Really, you're going to have to rely on your realtor to help you look at what are other properties in the area selling for, and what is the cost of renovation to bring that up to a similar condition, and what discount should you be reasonably able to expect for being the one having to do that work.
No, I mean, yeah, I mean, I agree with Josh. But maybe find out from the agent what's that guy looking for, or girl, or whoever the seller is. What are they looking for in an offer? I mean, might be able to have a conversation, and maybe you're way off and you can just move on. I mean, I had a conversation with somebody the other day. The property was listed for six something. No, it was listed for 519. And before that, it was listed at 719. So they dropped it $200,000. And in my eyes, it was worth about 575, 580 to start with. So I had a conversation with the listing agent. And I said, well, what's the deal here? She said, well, initially they wanted $1 million for it. And I was like, huh? She said, yeah, they wanted $1 million for it. And I was going to stick with it. So I finally got them down to 700, and that's where we listed it. And they realized that wasn't the price. So now we're down to 500. So, I mean, again, I don't know where I came up with that story or why that's even significant, but I just thought I would throw it out there because people are nuts in what they think their properties are worth sometimes. So maybe having a conversation with your agent, find out what they truly think it's worth, find out from the listing agent what they think it's worth, and maybe you can put a deal together when these people actually come to their senses. And maybe you're not that far off to begin with, but you might find that you're way off in what they want versus what you're willing to offer. And it's a good time to maybe just move on, or just, let them know that you're there if something changes with regards to, how they approach the value of their home. But anyway, we're moving into the final minutes here, guys. Let's see here.
So Dylan had an excellent comment. He said, "There's one dislike on this video. I think it's Will. I think it's Will."
It is. It was definitely Will. Will, you're so angry, man. Come on, this is a good show. We're spreading positivity here.
It's nonsense. It's nonsense.
And Irwi came back and said that he was approved for the home style renovation loan. So something similar to the 203K. So it sounds like, so find out, are they not accepting it because you're doing a renovation loan, or are they not accepting it because of your price? Maybe try to find out a little bit more information there, so that if you do decide to write another offer, you can better present it, if you will.
So Jeb, let me throw this one up here. Michael follows up with, "Hey, Josh, I believe you emailed me a lender in Texas some months back. Do you have one closer to Dallas you recommend?" We can find you someone closer to Dallas, but this question comes up a lot. It comes up a lot on the show. Someone says, "Hey, I'm in Sacramento," or "Hey, I'm in Redding," or "Hey, I'm in San Francisco. Do you have someone?" We talk a lot about the most important thing is working with an expert. I think it's important to work with someone in your state, or at least does a significant amount of business in your state. So let's say that there's a lot of California brokers that are approved in Texas. If you do 100 loans a year in Texas, I would assume you're pretty familiar with some of the quirks of how business is done in Texas. What I don't think is important is someone being in your city. We did, I think, 243 loans last year. 3 came into my office, and some of those are Jeb's clients in Huntington Beach, right in our town. 4th of July, I met a client of Jeb's that bought less than a mile from our office that I never met him. There's no need to, because of the technology. So if you feel it's important that you want to walk into someone's office, look them in the eye, and have that experience, by all means, Michael, we'll get you connected with someone. But any of you guys, we help clients throughout the state of California. Maybe 50, 60% of them are in LA, Orange County, and the other 40% are about the state. For the state of California, everything's pretty much the same from north to south. In Northern California, on a purchase transaction, we don't get escrow instructions until the loan docs go out. That's the only difference. There's a little bit of difference in how the closing costs are structured. Now, the difference between California and Texas, massively different. I'm not even approved in Texas, but I've never done a loan in Texas, and I would assume that I would not be the best bet for you. But whether someone's in Dallas or Houston or San Antonio, they should know the way business is done in Texas and can help you. And that's the same for any state. A lot of states are similar. Like if it's an attorney state versus an escrow state, Oregon, Washington are going to be very similar to California. But there are regional differences. But what is most important is working with an expert that does a lot of loans. That's not, hey, I want to work with the guy that does or girl that does the most loans in the United States of America. But they have to do enough to see a lot of files, to have the experience, to get you accurate answers, and have a system and a process to get you what you want. Like the difference between what Jeb does as a realtor, that's a lot relational. Like if you didn't like Jeb, you're going to be in a car going and looking at houses and writing up offers.
Nope, you're driving your own car these days, bro. Not even in the car with me.
Pre-COVID, Josh. So
Yeah,
you're going to be following Jeb in his car, and you're going to be having a lot of conversations, and that's more of a touchy-feely relationship. We have that. My clients will get on the phone and we'll go through this stuff all the time. But really the important part is, do they have a system and a process to get you from where you are to where you want to be with the lowest cost and getting you the answers at every step in the way? Like when we have designed our system for doing loans, my goal is to know what you want to know and need to know at every step in the way, so you're not having to ask. So when we send out a status email, say, this happened, this is what that means, this is what comes next. So long way. You're just asking about someone. If you want someone closer to Dallas, we'll get you someone closer to Dallas. We definitely have other people. Freba followed up here saying she's in the Bay Area. For us, we're in Southern California. We help a lot of clients in the Bay Area. We would love to help you. So again, no matter where you're at, we have people that can help you. And I wouldn't be as concerned with someone geographically close to you as in geographically experienced for you.
All right. And I agree with Josh, right? I mean, finding a lender in the state is I mean, finding a lender in your market is less important than finding a knowledgeable, experienced lender in the area that can do your loan. So that is less important than when you're in a market, finding somebody that actually knows the market that you're looking to purchase, right? So if you're looking for a real estate agent, try to find somebody that knows the market that you're in. You know, and like Josh said, you know, the more properties, he used loans for a reference, but the more experience, the more, you know, at bat somebody has with doing it, the more experience they're going to be, and the better they're going to be able to serve you and guide you through that process, and be able to help you see things from an experienced perspective versus somebody just getting their license and going out to show you a couple of homes and you making offers, right? There's two ways to go through a property. One is with an agent just there and you're touring the property. The other one is where the agent's there with you, pointing out everything in the property. And some may not agree with that approach, but that's the way I do it, because I don't want you to come back later and say, well, I never saw it, I didn't notice that, I did, you know. We're seeing everything up front, so that you know exactly what you're buying for the most part, outside of an inspection prior to ever making that offer, right? You're there emotionally, I'm there logically, and we're trying to come to grips with whether or not it's the right property for you. So experience matters. But anyway, we're going to go with a question here. How will the CFPB rules that go into effect August 31st, sound like Mike Tyson, August 31st impact the real estate market? From what I understand, will delay foreclosures to 1/1/22. So I'll be honest, I'm not familiar with the CFPB's rules that go into effect. I'll do some reading. I'm not up to date on what that means. I do know that they were trying to put information in place with regards to the way forbearances were handled and this sort of thing with regards to servicers. I realized the CFPB was on that side, but I'm not aware of anything unless these two tie together with how it's going to result in a delay of foreclosures. But I'll have something for you next week if that's the case. Josh, are you familiar with anything there?
No, other than just talking about the foreclosure moratoriums, that they just keep pushing things back for forever. You know, I had some numbers, and I wish I had printed them because I wanted to talk about them tonight. The vast majority of people have exited forbearance. So there's still a chunk. I know it was a number, I think it's 1.7 million people still in forbearance, but it's
how many
down.
would you say?
1.7 million. Does that sound right?
1.8, but yeah.
Okay, so
on the last number, yeah, somewhere in there.
Somewhere in that range. So it's way down. And they're certainly people that don't, but on average, they all have more than enough equity to sell. I think the number was 85% have 10% or more equity in the property. So they will be able to sell. How many will need to versus, again, we look at the forbearance. If you were in forbearance, they're not coming back and saying, hey, we're going to increase your payment or we need that money. For the most part, government-backed loans, they're just saying, we're going to tack it on to the end. You're basically getting an interest-free loan for the payments that you took and skipped for the last year. I don't see how that causes anyone a problem. Again, if you had a job before COVID, there's employers looking for jobs, employees everywhere. So unless something bizarre went on in your life, it's not COVID related. You're going to get a job and you're going to be able to pick up your payments after the fact. So some people will have forced sales due to forbearance and COVID, but they're going to be very minimal, and the market will rapidly and easily absorb them. Jeb, I don't know if you saw it here, but our friend Brian Espinosa
I was
came
just
back
going to
and
click on it. Yep.
gave us the details you were looking for. So he got qualified for $650,000, wanted to buy a home in Roseman, California, Kern County, but they have income limitations. Basically, I make too much, so I can use $365 to bid and the rest out of pocket. Brian, that unless it's a special kind of loan program,
I'm thinking it's USDA maybe, because of the income restrictions. That's the only loan program I'm aware of that has.
But paying money out of pocket, it wouldn't be an income limitation. It would be a loan amount limitation.
Well, but USDA does have income limitations on you not even qualifying. So in that case, you wouldn't be able to qualify at all.
Right. You know what I'm saying?
Yeah.
So.
Yeah, I'm not sure either, but reach out to Josh, Brian, and have that conversation and maybe have him run the numbers to see exactly where you are and provide a little bit of guidance there. I think that could help, clarify whatever it is, and clarify on everybody's side, right? I mean, help Josh understand. And I think once he gets clarification, he can probably tell you why that's the case. But outside of that, you shouldn't be limited on your income. Unless you're buying a property, for example, that is inclusionary, like a part of a housing program of that city. But even then, it's not like you could qualify for less and bring more money in. They don't work like that. So anyway, talk to Josh and we can go from there. Let's see here. I'm going to answer this last question. We're gonna wrap it up here because we're pushing 2 hours. Well, go ahead. Are you gonna?
No, I like it. That last question just popped up. I like it. So throw that one
yeah. So Vanessa Flores is asking, do agents ever bluff when asking for your best offer? And the answer is absolutely, 1000% they do. Should they? No, right? You should be a good enough negotiator, a good enough salesman. Because that's the job you're in, to be able to negotiate and sell without having to lie to somebody to get their highest and best offer. But I do know it's out there. I see it happen all the time. People say I have multiple offers or whatever, and the property's still sitting on the market 2 weeks later, that sort of thing. So yeah, it happens. It's not ethical. It shouldn't happen, but it does. And unfortunately, there's not really a way around it, because, there's no way to necessarily prove it one way or the other when having those conversations. Josh, anything you want to add on there?
No, you specifically had one on Sonny's deal. They had multiple offers. They sent out highest and best. You wrote them back a highest and best offer, but it wasn't increasing his price. And magically, we got that. So it wasn't necessarily a bluff. That's a good agent on the other side.
That's not true. And this goes to the question above. We're going to answer one more too, because I wrote back the same offer, but I wrote an escalation clause in there and said we were willing to go up higher with the escalation clause. And our escalation clause never escalated. We got it at our original price. So they asked for a highest and best. They never said that we weren't the highest. And so in that case, we wrote it at our price, added some escalation on it, and we still got it at our highest price because in that case, I believe were the best offer. But somebody asked a moment ago about escalation clauses. And so while we're here, we'll just touch on it. I don't remember who asked it, but they asked, is it going to hurt their offer? No, it shouldn't. But make sure that your agent can have a conversation with the other side and explain what it means and how it works so that they know exactly what it is. But it could put you in a position where you could make a strong offer without having to offer over or offer your top price initially. Maybe it can escalate to that, or maybe you can end up getting it for less money, before the escalation clause ever kicks in. So I recommend them if you can use them, absolutely. But you just need to make sure that all parties understand how they work so that they can, convey that to their client when they're having that conversation about the offers. Anyway, Josh, we are 2 hours into this. Asking a favor, if you're still here, you haven't already, hit the like button, help Josh and I out. We watch this nonsense. We just sit there and watch the little thumb. If it doesn't move, it's like paint drying. For hours, we sit here and it hurts. It hurts the eyes. It really does. Josh he's not going to get any sleep tonight unless there's like 200 on there. So come on, people, help him out. Josh, what are we going to do? What if you're sick? What if you have COVID?
The worst part is I told you they finally sent my test results last night. So my wife got it. So I am isolating. So I'm spending all of my time in the garage or the guest bedroom, which is awesome. But after my isolation, I tested on Sunday when she tested positive and got the results back last night. It says you're all clear. And the detailed test, not the little quick rapid one. We get to the end, and now I wake up today and I feel funny. So I could be hypochondria. I could be.
Bro, you just feel funny. You. It's because you feel funny. That's why. Oh, geez. Jennifer, thank you for the super chat. You're awesome. You rock. I should be paying you, and I don't know how this is going the other direction, but I'll take it for the moment. Jeb's email is there. That's me talking in the third person. There's Josh's email there as well. Had a couple people reach out and ask for those. But guys, we appreciate you being here. There's a link in the description below if you want to get connected with a real estate agent across the country, a mortgage lender, a broker, lender across the country, professionals, people that do business the way we do. I'm happy to connect you there. A lot of you have and have had great experiences and continue to reach out. So we appreciate that. And we appreciate you guys being here. We should be back next Wednesday unless something. I'll be back regardless. I don't have COVID. But
I could be in the hospital.
Josh could be in the hospital. And quite frankly, if he is, there would be nothing better than to do a live with him sitting in there. So I'll figure out some way to make that happen.
Well, let's tell everyone the worst part. So I got back from South Carolina Saturday night. This was supposed to be just a crazy hectic week, and then driving to Washington this weekend to have my shoulder replaced. So I was out for next week, but due to my close contact with my wife with COVID, I now don't get my shoulder surgery.
That's your problem, bro. You're hanging out with your wife.
Hanging out with that lady too much. Yeah.
Anyway, thank you guys for being here. We will see you soon. Leave any additional comments in the comment section below. We'll address them next week. Adios. That wasn't the right one. People were back. Look at that.
Do not torture them with that music again.
You thought we were going to leave you like that? No, we're going to hit you with this one.